Good day. I'm Rashaad Tayob, a portfolio manager on the Nedgroup Investments Stable Fund, and today I'm going to talk about the portfolio and the market outlook as we head into what is going to be a very interesting year over the course of 2024, both domestically as well as internationally. If we look at the performance of the fund over the last year, it's in line with inflation, but hasn't beaten inflation for reasons I'll talk about in the next slide. But over the longer term, we've managed to beat inflation over 10 years and 15 years. If we look at the key drivers of performance over the last year, where we've delivered performance was from the domestic side, bonds, cash, as well as the property sector, as well as other assets, which is the gold position, which has performed quite nicely more recently. What hasn't delivered and was a large weight of the portfolio was the foreign component, where conservative positioning and exposure to China meant that while it delivered a positive return, it didn't keep up with the global markets, especially the fast rising S&P 500 and the tech sector, which was the biggest driver of global markets over the course of 2023. So after a standout year in 2022, where the global funds delivered very excellent performance in a downturn, there was somewhat of a lag last year, but we do expect them to come through given their positioning for the year ahead. Let's start by looking at the global outlook and firstly a focus on what's happening with global rates. Now, this is a chart of what the expectation is or what the market is pricing in for the Fed funds rate at the end of this year. And you can see that after pricing in a very bullish outcome where rates were going to be cut very aggressively, that happened in the last quarter of 2023. This quarter, we've seen a full reversal of that, and the market has totally discounted rates. The expected slowdown of the US economy, the expected moderation in inflation has not materialized, and therefore the market has been forced to pull back on its expectation of rate cuts, and this will have an impact on asset prices down the line. Now, when we look at the debt situation in the US, the US needs lower rates in order to cut its cost of debt. We've seen on the right-hand side a massive increase in the total amount of government debt outstanding. The US got used to spending quite recklessly during COVID, and they haven't been able to drop the habit. You're still seeing deficits of close to $2 trillion per annum. And when you have a lot of debt, you've got to pay interest on that. And the debt service cost, on the left-hand side, you can see this is a long-term chart. For many years, debt service costs were around the $300 billion per annum. And this year, they're set to exceed $1 trillion. Now, in an environment where revenue that comes into Treasury is around $4.5 trillion, this means that debt service is now taking up over 20% of of government revenues. That's a very risky position to be in, and it's the reason why the US would like to reduce rates and get that interest cost down. However, if we look at the inflation scenario, this is just not allowing them the opportunity to cut rates. What I've got here is a chart of US core inflation broken down into goods and services, and you can see that over the last 6 months, US core inflation got down to 4%, but over the last 6 months, it just isn't coming back down towards that 2% level. And if you look at the makeup of goods and services, you can see that while goods was a big driver of the inflation spike, goods inflation has actually come down and is actually a negative now, so it's actually pulling inflation down. But services, which is the larger component and is very much driven by the low unemployment rate in the US, is sticky at around the 4% level. So that's not giving the Fed the opportunity to moderate rates in order to support both the economy as well as the cost of debt servicing from a government perspective. And in an environment of sticky inflation, rising geopolitical risk, and US debt problems, one of the assets you'd really like to hold in that scenario is gold. And as we've seen in the last few months, gold has broken out of that $2,000 level, which it reached a few times in recent years, and is making new all-time highs. And the outlook for geopolitical risk worsening, as we've seen very recently, and you have geopolitical situations across Europe with the Russia conflict, the Middle East, as well as trade wars with China, in this type of environment, the outlook for gold looks very positive, and it's a key part of our portfolio in the stable fund. Looking at South Africa, this is a chart of the 20-year bond yield minus JIBAR, which is your money market rate, and you can see that over the course of the year, that spread has picked up and is close to the 4.5% level. Now, that's a very healthy premium of government bonds above money market, and it's a reason why we hold a component of government bonds in the portfolio, as a lot of the risk is being priced in. An asset which we've been adding to over the last year are inflation-linked bonds. This is the 10-year inflation-linked bond yield. This is the real yield which gets added onto your inflation. And you can see here that this has adjusted up significantly in recent years, and you're now getting a 5% real yield. That's very attractive for a South African investor, and it's a reason why we've been consistently switching the component of the nominal bonds towards inflation-linked bonds, as we really like the risk-return attributes of the asset class at these levels. However, investing in government assets, be it your nominal bonds or your inflation linkers, are not without risk. And when we look at South Africa's debt profile, you see a very worrying trend. We crossed R1 trillion of debt for the first time in 2011, and we're set to end this year with close to 5.5 trillion of debt, heading towards 6 trillion. Now, if we can't get a positive growth environment and get growth back to the 2 to 3% level, we've only had 1% growth for the last decade on average, and that's not a sustainable environment. If we don't get high levels of growth, then a debt crisis is inevitable. So we have to be cautious, and that is part of the reason why we have been moving a nominal bond component towards inflation-linked bonds, which will provide more protection in an environment with a high debt trajectory. Now, we're heading towards a very uncertain outcome, heading to the elections at the end of May, and things have changed quite significantly. If we looked 6 months ago, we would have estimated that the ANC, while it would have lost significant amounts of support, we estimated it would still get close to a 50% level, which will enable it to form a coalition with smaller parties or maybe the IFP, and we'd get a business as usual type outcome, whereby we're very familiar with the ANC over the last 2 decades. We're very familiar with the current President Ramaphosa. So a relief rally would have probably materialized, where we would have seen local assets, including bonds and local equities, perform quite well, as a worst case scenario would be avoided. However, the re-emergence of Jacob Zuma and the emergence of the MK party in recent months has thrown a spanner in the works. And the last 2 polls we've seen have seen ANC support drop to around the 40 or even slightly below the 40% level. And if that materializes, it means that the ANC won't be able to maintain its support with smaller parties or the IFP, and it's unlikely to be a business as usual outcome. In that kind of scenario, the ANC will see a fork in the road, and the ANC will be forced to choose between an economic reform type of environment, which will be an alliance with the DA, or a further shift to the left, which will be an alliance with the EFF or the MK party, or potentially both. And those lead you to very different outcomes. One is very positive and one is very negative for asset classes as well as the rand. So this is a very difficult environment and a very uncertain environment over the next few weeks. And we'll be closely monitoring the polls to understand whether the recent trends in terms of the rise of the MK is sustainable, and looking at the potential outcomes in that scenario. If we look at the offshore component, which is a big part of our asset base, this didn't do well over the last year, but we're quite positive on the outcome over the course of 2024. If we look at a big component of Ford's holding, which is in Chinese equities on the left-hand side, you can see the big earnings recovery that came through in terms of our underlying assets that we hold. The shares that we hold had 30+ growth in earnings. But on the right-hand side, if you look at the PE of these investments, given the negative sentiment towards China, given the level of disinvestment, these assets derated despite positive fundamentals. And if you look at the ex net cash investments, you're looking at low single digit PEs, 5 or 6 PEs on our investments, which bodes very well if the Chinese economy does recover over the course of this year and some of the geopolitical risks do abate. So we do see very positive potential from the global component as we go into 2024, and a nice recovery from that will lead to a positive outcome on our on the entire portfolio. If we look at the change in the portfolio and its makeup over the last year, we do see a shift towards a higher foreign holding as we've bought in when the rand was at relatively attractive levels. Our local component has stayed quite the same in terms of equities and property. The government bonds have been trimmed, but what's important to note that the makeup of government bonds has shifted from a full exposure to nominal bonds and we now 10% out of the 26% in government bonds is now into inflation-linked bonds. And we like the risk return on that asset class, and we like the 5% real yield that we're getting on those assets. The commodity component at 5% is primarily the gold exposure, and we're very happy with the potential returns available there. And then we also have a money market exposure where we're getting JIBAR plus 2 to 3% on assets with low levels of credit risk in that component. So overall, very happy with the portfolio as it's structured, and it's resilient to a range of potential outcomes. So in an environment when global assets prices are elevated and we had a strong rally primarily in the S&P and the Nasdaq, we don't have a high exposure to that overvalued portion of the market. We have a larger exposure to better valued assets, and especially towards Chinese type of assets, which are extremely cheap with good growth potential. Inflation remains sticky, and I think the room for rate cuts has been minimized. We've seen that come through in the last quarter as rate cuts have been priced out. And with high levels of rates, we do think that there is a risk for asset prices over the next quarter or two. Politics and geopolitical risks remain elevated, and in that type of environment, we do like the gold exposure on the fund. The SA economy remains structurally challenged, and even if we do get a business as usual outcome and the ANC retains its majority, we don't see room for significant change, and the economic stagnation that we've seen over the last decade is likely to continue. SA bonds offer reasonable value, but we do see a little bit more value in inflation-linked bonds, and we are shifting the portfolio towards that component. And physical gold is an attractive diversifier and a great hedge against risk-off events. Diversification is extremely important, and we do think that the mix of assets in the stable fund has excellent return potential and will deliver inflation-beating outcomes. Thank you.